So the auditor's report, is a number 700. And in our 10 points, which we discussed as stages or steps of an audit, this is step number 10. It is step number 10. If you can recall how we listed, we talked of number 1, practical legal ethical review. Number 2 was obtaining references. Number 3, meeting the previous auditors. Number 4 is a 210 engagement letters. Number 5 is a 310 background research. Number 6 is a 300 audit planning. Number 7 is a 315 risk assessment and ICS review. Number 8 is a 500 audit evidence. Number 9, we talked of auditing or reviewing non-financial items, which included is a 550 related parties, is a 560 subsequent events, is a 570 going concern, is a 600 special consideration group audit. Then number 10 is a 700 auditors report, and it's a 260 management letter. So it's the last item in the audit engagement, and that's why we say it is the ultimate product. It is the ultimate product during audit function, audit functions, the ultimate product. Is the last thing, because we've already gathered evidence and now we want to form an opinion of ultimate product during audit exercise. Then we say it is a requirement of Companies Act. Requirement of the Companies Act, i.e., duties of an auditor. Yes, which requires the auditor, to report whether, Roman number 1, he has received all the information and explanation. All the information and explanation deemed necessary for the purpose of audit. From number 2, whether he has received sufficient returns from the branches. The branches are not visited. Number 3, whether the financial statements, are in agreement with the books of accounts, From number 4, whether the financial statements have been prepared as per the Companies Act, as per the Companies Act provisions, in the manner so required. Number 5, whether the financial statements, whether the financial statements have been presented fairly, in all material respects, in all the material respects. Roman number 6, whether the financial statements, portrays a true and fair view. So that's what the auditor is reporting about. And that's what the auditor is reporting about with regard to the client's financial statements, with regard to the client's financial statements. Elements of an auditor's report. Of course, we talk of the 10 elements. Talk of title, but we talk of addressee. But we talk of introductory paragraph. Number 4, we talk of management's responsibility paragraph. We talk of number 5, auditors' responsibility paragraph. Number 6, opinion paragraph. Number 7, other legal matters. Number 8, auditor's address. Number 9, auditor's signature. Number 10, dates. 10, dates. So those are the elements of an auditor's report. Those are the elements of an auditor's report. Title is very important. What the title does, it distinguishes the auditor's report from any other report. Because at the top there, we always indicate independent auditor's report to the members of ABC Limited. So independent auditor's report to the members of ABC. So we are clearly indicating it's an independent auditor's report. The addressee is a way of minimizing the auditor's liability. We are indicating who are the intended users. Introductory paragraph, we are introducing the client that we are auditing. We are introducing the financial statements that we are auditing. We are indicating the financial period covered by these financial statements. And of course, we start by saying, we audited. Remember, the 9 ways of minimizing auditor's liability, one of them is indicating clearly work done, work not done, and any limitations in scope. So here we start by saying we audited KCEs, income statement, statement of financial position, cash flow statement, and trial balance for the year ended, that was December 2023. That's how the introduction looks like. These 2 paragraphs, sometimes we call them scope. We call them scope paragraph. And they're very important for purposes of reducing the expectations gap. So we clearly indicate what the management's responsibility. So management's responsibility is to prepare financial statements, to avail these financial statements for audit, to make reasonable estimates, to identify appropriate accounting policies and ensure consistency in their use, making reasonable estimates, all those, we highlight them. Responsibility to design very strong internal control systems, responsibilities to prevent, detect, and correct errors, fraud, irregularities. We capture them there to have clarity of the scope of work with regard to management. Then auditor's responsibility is very important. We always start by saying that we carried our audit guided by the relevant ISAs. That's the starting point. We did it as per the relevant ISA, nothing else. Because sometimes when you're carrying out private audit, as much as we want to satisfy the client's needs, we need also to observe the relevant professional pronouncements. So we were guided by ISA, then we indicate that we assessed the strength or otherwise of the ICS, which influence on the audit approach to apply. Step by step, we relied on the work of an expert, we relied on client's ICS, work of the internal auditor, all these under the auditor's responsibility paragraph. Then the opinion paragraph, we always start by saying, in our opinion, then we indicate our opinion. And that's why we say that board corporates are disqualified to audit because they are not in a position to form an opinion. So in our opinion, the books of accounts of KC Limited have been presented fairly in all material respect, and they portray true and fair view, something of that nature. Then other legal matters, all these are other legal matters. Number 1 to number 6. We refer to them as other legal matters. That's why we say it comes paragraph number 7, if any. We mean if any because you've seen they're the same phrases we're using to form an opinion. So we may not see the need sometimes to have it because we've already indicated that in our opinion, the books of KC Limited portrays as true and fair view and have been presented very in all material respect. We may leave it as that and it is still fine. The auditor's address, auditor signature, and date. In practice, sometimes auditor's address will not come here because the papers that we use to do this report, they already have the auditing firm letterhead. So their addresses are likely to be at the top of all the paperwork that we are doing. But their signature, the date, very important. And this is not any other date. It is the date after you had gathered sufficient appropriate evidence to enable you form an opinion. So we can't have today's date here and we are still gathering evidence. It should be after we had gathered sufficient appropriate evidence to enable us form an opinion, Subtopic, types of auditor's report, stroke opinion. Types of auditor's reports, stroke opinion. Number 1, we have unmodified, stroke unqualified. Unqualified report. Number 2, we have modified opinion. We can start with number 1, unmodified opinion. Unmodified opinion, I will say, it is a clean bill of health. It is a clean bill of health, i.e., a favorable opinion, issued when the auditor confirms that A, the client's books of accounts portrays true and fair view. B, the financial statements. The financial statements have been presented fairly in all material, respect. In short, you are saying when the auditor cannot introduce any reservation to the other legal matters, then they issue a clean bill of health. When they cannot introduce any reservation, cannot introduce any reservation to the contents, of the other legal matters, then we issue unqualified and modified report, which is a clean bill of health. All right. What are the effects of this? Effects. Number one, we can say that share price of the company, shoots up or goes up. Increase in share price of the company. Yes, we can talk of potential investors show up. Potential investors will show up. Yeah, we may even have the element confidence by the shareholders. So shareholders will have more confidence on confidence by the shareholders on the work done by directors. Work done by the directors. Roman number 4 is directors' contracts. Directors' contracts may be renewed. Yeah. Basically positive repercussions, positive effects, positive effects, positive effects. Yes, we may even indicate that auditors' term may be increased or added or renewed. It should not form the basis of renewing the terms of auditors. That's why I'm using the term may be renewed. You may be impressed until you feel, let me continue engaging these auditors. But you know, this should not form the basis of renewing their terms or even dismissing them. It should not form the basis. Because basically what we are doing is reporting on the financial position of the client. They're just giving their opinion about the financial statements of the client, amongst so many other effects and repercussions. Let's look at modified opinions. Modified opinion. So we're saying we are modifying our opinion if we are issuing a modified opinion. If we feel that the books of accounts do not portray true and fair view, that the financial statements have not been presented fairly in all material respect, then we say this is a bad report. This is a bad report with the following effects, with the following possible effects, with the following possible effects. Roman number one, we say the company may be delisted from stock exchange, Roman number two, the company may be put under receivership. Roman number three, an investigator may be appointed to look into the affairs, of the company, Roman number four, share prices may go down. Roman number five, company may be restricted to pay dividends. Company may be restricted to pay dividends, Yeah, auditors may be replaced. Auditors may be replaced amongst so many other negative effects. Subtopic: types of modifications. Types of modifications. Yes, please. Number six. Auditors may be replaced. Yes. Yeah, that's why I explained it should not be the basis of replacing the auditor, but the client may feel that the auditor's opinion is not okay. You may feel that the auditor gave an opinion which does not represent the situation on the ground. Then we go ahead. That's why when you're discussing reasons why auditors may be replaced, we include disagreements between the auditor and the client, because we may feel, no, this auditor is taking a very pessimistic position as far as our financial statements are concerned. We replace them and maybe we go ahead to look for other auditors. So it may form the basis of replacing the auditor. Yeah, it's the same question the online family are asking. Why is this happening? Why is this? Yeah, three questions asking about the same. That's why I've explained the word may. It's not outright that you give a modified opinion, you are replaced. No, unless the client feels that the opinion you've given is not in good faith. It's not in good faith. You have your own issues, you are biased, you're not independent, or something of that nature. They are not satisfied. If they're not satisfied with your opinion, they are likely to replace you and look for another audit. Types of modifications. Types of modifications. Number one, modifications affecting the auditor's opinion. Number two, modifications not affecting the auditor's opinion. So we start with number one, modifications affecting the auditor's opinion, where we say this is discussed using the qualification matrix, below, using the qualification matrix below. So we look at nature of circumstances. We have the element of limitations on scope. Then we have disagreement. Then material and pervasive. Material and not pervasive. So that's the qualification matrix. Good, good. Modifications affecting the auditor's opinion. Modifications affecting the auditor's opinion. These are 2x2 matrix. So we need to understand these components we are referring to as nature of circumstances. Starting with the number 1, limitations. On scope, we say that arises when the auditor is not able to gather some evidence which he considers very important to enable him form an opinion. So get this right, that this is arising when the auditor is not able, or the auditor is unable. Yes, is not able or is unable to gather evidence which you would have considered to be very important, very important to enable him to form an opinion. So some evidences are missing, and you consider them very, very, very vital, very, very, very important. This would arise as a result of, number 1, circumstances beyond the management. Circumstances beyond the management, i.e., financial statements destroyed, e.g. by fire, seized by a government, authority, etc. So either they've been destroyed by fire or seized by a government authority. Say you've gone to audit only to find that KRA have carried these books. Maybe they're suspecting an element of tax evasion. So there are no books or accounts. Yeah. Roman number 2, auditor being engaged at a time when he cannot be able to perform. He cannot be able to perform some standard audit procedures, e.g. debtors, circularization, Yeah, a client may engage you, say, somewhere on 20th of June, and 30th June you're supposed to file returns. So you only have 10 days to gather evidence, form an opinion. So you can imagine circularizing a data. Yes. And maybe this data is like myself, who responds to a message after 6 days. Yeah, so it means that they will be responding after you have already formed an opinion. So you'll not be able to perform some very important audit procedures. Number 3 rather, circumstances within the management. Circumstances within the management control, e.g. hostility, lack of cooperation, lack of cooperation, and sometimes being denied access, being denied access to evidence. You may wish to call a debtor, you may wish to contact a debtor, but the client is not availing debtor's contacts. You want to confirm something, maybe you want to confirm, we know debtors, we may be confirming about the DAV acronym, their existence, their valuation, whether they belong to this client, and whether all the debtors have been disclosed. But the client is telling you, kindly don't call that debtor. Huyo mzee huwa hasumbuliwi. Huyo mzee achana naye huwa hasumbuliwi. Is hapendi mambo ya simu and everything. You are discouraged, you are denied access to such evidence. You modify your report citing limitations on scope. So when this arises, you are modifying your report citing limitations on scope. That's it there. Let's discuss disagreement. Disagreements. So here we say, unlike in limitations in scope, unlike in limitations on scope, here the auditor has managed to gather sufficient, appropriate evidence, unlike in limitations on scope, comma, here the auditor has managed to gather sufficient, appropriate evidence only that the auditor's position, may be at variance, with the position adopted, by the management, may be at variance with the position adopted by the management. Tunatofautiana. We have all the evidence. That we require, but we are disagreeing on some aspects of the financial statements. Full stop. The areas of disagreement may include, so it could be disagreeing on amounts and figures. We could be disagreeing on presentation. And disclosure. Presentation and disclosure. We may be disagreeing on interpretation. Of an accounting standard. We may be disagreeing on consistency use of accounting policies. We may be disagreeing on wires. There's so many other issues that we have all the evidence, but we are disagreeing on the amounts. We could be disagreeing on accounting treatment. On accounting treatment. We could be disagreeing on accounting treatment. And so many other things. And so many other things. So tunatofautiana. We have all the evidence, all evidence that we perceive sufficient, appropriate, available. Lakini tunatofautiana. You have made provisions for budgets to the tune of 1.2 million. That's fine, but we feel upon performing trade analysis and guided by what we call aged debtors analysis, we feel that this should be somewhere at 2.7 million. So we have the evidence, but we disagree on figures. We disagree on amounts. We disagree on amounts. That is disagreement. That is disagreement. All right. Let's define material. Let's define material. Let's define material. Material. So we say an account balance or an account balance or a transaction is considered to be material if it surpasses the auditor's materiality. It surpasses the auditor's materiality threshold. An account balance or a transaction is considered to be material if it surpasses the auditor's materiality threshold. If it surpasses the auditor's materiality threshold. So needed to tulisoma kwa ISA 320. ISA 320. That upon proper background research, ISA 310, you set a threshold. That with regard to this client, anything above 2.6 million is material. Below it, it is immaterial. So if what is missing, that's limitations on scope. If the contentious information, that's disagreement, have surpassed the auditor's materiality threshold, then it is material. Then it is material. Then let's define pervasive. Let's define pervasive. Let's define pervasive. Let me give you an example so that we get it right what it means. Let's say you have decided to invest. You have decided to invest in company A because like last year, they made PBT, profit before tax, was to the tune of 894 million. Then their debtors were to the tune of, you can talk of 72 million. You've made a decision to invest in this company. Only for you to realize later that these profits have been overstated they've been overstated by 8 million. They've been overstated by 8 million, which relates to a debtor who has been declared bankrupt. So these are doubtful debt or bad debt. Let's call it doubtful. Doubtful debt, because we know in the B sheet we record debtors minus bad debts minus provisions for doubtful debts. Again, in the income statement, provisions for doubtful debts is an expense if you're doing it for the first time. For the second time, we know we always check whether it's an increase or a decrease. Increase is an expense, decrease is an income. Now, you had already made a decision to invest here. You've realized that Debtors overstated by 8 million, and so are the reported profits. Would you still invest in this company after this revelation? Would you still invest? She will not change her mind. You still invest? You don't think? You don't think it's material? Yeah. Good. Same thing. So the right word we use there, this figure is not pervasive because it will not affect your decision. After all, you proceed to invest because it is not pervasive. It is not significant. It is not significant. It does not take up a significant proportion of the balance which it comprises. It does not take up a significant proportion of the balance which it comprises. But if we had reported, or the client had reported profits to the tune of 12 million, profits to the tune of 12 million, only to realize that in the real sense, the client made losses to the tune of 8 million. This time you are likely to change your mind. You are likely to change your mind because this would be a very risky affair to invest in a business which is already indicating a negative trend, indicating negative trend. So that's what we mean by pervasive. So we say an account balance or class of transaction is considered to be pervasive, if it takes up a significant proportion of the balance which it comprises. If it takes up a significant proportion of the balance which it comprises, which it comprises, i.e., when it is likely to affect a decision made by an intended user, it's likely to affect a decision made So can we say pervasive is immaterial? No, pervasive is material. Not pervasive is not material. Pervasive is material. In other words, we may say that pervasive means material, while not pervasive may mean not material. So we are talking of pervasiveness because that one we can assess, but materiality, it varies. Materiality varies from one auditor to another. What you may consider material, someone else may consider it totally immaterial, may consider it totally immaterial. I want us to look at a question. We see whether we can be able to form an opinion. Past paper question. Question. So, and there it is in a group. All right. So the question is already there in our WhatsApp group. So maybe you can check through this paper. Question number 1A is testing on forensic audit 12 marks. Question 1B is testing on going concern, 8 marks. Question number 2A is testing on materiality, 6 marks. Question 2B is testing on fundamental ethical principles, that's confidentiality, 4 marks. Question 2C is testing on ISA 700 Auditors Report. Question number 3A is testing on group audit, 12 marks. 2B is testing on what? Yeah, 2B is testing on ISA 520, analytical review procedures. Analytical review procedures, 8 marks. Question 4 is testing on risks. Let me see if I can see those other questions in that way. I don't know whether I can be able to trace it again. So you see, for instance, in that paper, yeah, question number, yes, I've said, question number 4A is testing on risks. 4B, Roman number 1 is testing on corporate governance. 4B, Roman number 2 is testing on environmental audit. Then question number 5 is testing on auditor's liability. So the whole of that paper, what you've not run is on reward how many marks? I want to share these other bits. Yeah, of question number, the whole of question number, yes, there it is. So that you can see the whole paper. So the only area that you may not answer is for the 8 marks, the analytical review procedures. Otherwise, everything else, we have run. That's why I was telling you, you can easily handle a paper now. You can easily handle a paper now if you've really been revising, if you've really been perfect. Let's answer question number 2C. 2C. Oh, I don't have the question. My physical papers are not around. Let me first read. You are the auditors of PENAC Limited and Zepa Limited. For both companies, their end is December 31st. You are reviewing the working papers of the two companies, and the following matters have been left for your attention for the year ended December 31st, 2012. We have PENAC Limited. The account receivable, sorry, the account receivable were that 2 million Kenya shillings, which includes 3.2 million due from Beta Limited, which ceased trading on February 3rd, 2013. No provision had been made for this amount. The reported profits of PENAC Limited for the year ended December 31st, 2012, amounting to 640 million Kenya shillings. Then we have Zepa Limited. The company had 3 ongoing contracts, A, B, and C. Contract A and B were almost complete, and profits were recognized as appropriate. However, Contract C was 60% complete, and no provision had been made with respect to four-year losses, estimated at 50 million Kenyan shillings. The contract amount for the contract C was 600 million shillings. The company's management have indicated that no provisions were made since the losses would be offset against amounts received from contracts A and B, which were expected to generate profits of 300 million. Required. Draft the audit opinion paragraphs. Draft the audit opinion paragraphs for both companies. For both companies. Acha nifute hapa. We analyze together. So it's you to guide us on the type of opinion that you would give. See, those are how many marks? 8. At advanced level, even 1 mark is too much. So, learned friends, you can share through our chat box. There's some persons who, because they are not in our group. So about PENAC Limited, what we are being told, the accounts receivable are to the tune of that 2 million. So these are shillings in million. Out of this, Better Limited owes us 3.2 million. They have ceased trading. That February next year. No provisions have been made for this amount for the reported profits of PENAC Limited for the year ended December 31st, 2012, amounting to 640 million. So profits, net profits, 640 millions. They have not made provisions for these 3.2 millions owed by Better Limited, who have ceased trading. Yes, 3.2 million. So what type of opinion would you issue? Opinion. What type of opinion? Because we have already defined these terms. Now we are saying if some evidences are missing and these evidences have surpassed the materiality threshold and they are pervasive, you issue a disclaimer. If some evidence is, if you have all the evidence, but you're disagreeing with the client, and this disagreement, the contentious information, have surpassed the auditor's materiality threshold and it is significant, you issue an adverse. In both cases of limitations on scope and disagreement, if the missing evidence or the contentious information could be material, but not pervasive, you're supposed to issue a qualified opinion in both cases. You're supposed to issue a qualified opinion in both cases. Now, in this case, are we giving unmodified opinion or we modify our opinion? That's where we start. Are we issuing unmodified or modified? Modified. Good. Is it modified on the basis of limitations on scope or disagreement? Is it a disagreement? Yeah, it's modified. That's verified and Jenga, Moline, that's modified opinion. Is it modification as a result of limitations on scope or disagreement? It is disagreement. Chunguza. Yes, I'm told disagreement by Moline, agree, disagreement, Samsung, two disagreement. Yeah, I agree. These are disagreements. a disagreement. Because when you say its limitations and scope, you should be able to tell us what you expected and it's missing. You should be able to indicate that you're not able to form an opinion because they have not given us certain information that you regard as very important. So nothing is missing. We have the figure of debtors. We know better limited is trading the dates. We see the profits. So it's a disagreement. Are we issuing an adverse or an except for? Yes, an except for. Adverse. Bado. They're saying except for, ugly there, and Jenga except for. Yeah, it's an except for opinion. You? Yes. It is a provision. It's not a bad debt per se. It's not a bad debt per se, because them being declared bankrupt, there's a process of liquidation. Could be a process of being put under receivership, assets realized, and the proceeds used to make good. So what's happening there is doubtful. We really doubt whether they will pay us. Okay. Net profit overstated, debtors overstated. Even if we call them debts, they have the same effect. Because yes, they have the same effect. You call them provisions for doubtful debt, the same effect. Because both debts and provisions for bad debt, number one, are expenses. Number two, they reduce debtors. Because debtors should be debtors less bad debts, written off less provisions for bad debts. So they have the same effect. So you're saying this figure is so insignificant with regard to the balance which it comprises. PENAC Limited remains a profit-making entity, despite overstatement of profits, despite overstate. This is like 0.000001 with regard to these profits. It's like 0.0001 with regard to these data. So it is insignificant. So we issue an except for opinion. So what would you say? That should you say in my opinion or in our opinion? It depends whether you are a firm or you are an individual. Yes, in our opinion, comma, the financials, sometimes we say the income statement and statement of financial position, of PENAC Limited, portrays a true and fair view, except for the non-provision of doubtful debts, owed by Better Limited, except for provisions for doubtful debts. I think we would have recorded how much doubtful debts to the tune of sharings 3.2 million, owed by Better Limited, who have since ceased trading. In our opinion, the income statement and statement of financial position of PENAC Limited portrays a true and fair view, except for the non-provision of doubtful debts to the tune of 3.2 million Kenyan shillings owed by Better Limited, who have since ceased trading, ceased trading. Then you do what? After these, you're supposed to sign. You're supposed to sign. Let me remember how we go about here. Down here, you're supposed to sign. You're supposed to indicate your address and the date. Yes. You sign, eh? Then you indicate your name. Clement Tinovia, into brackets, audit partner. Audit partner. You're signing for CKN Associates. CKN Associates. Into brackets CPA case. PO Box 53847-00200 Nairobi. Then you indicate today's dates. 20th March. 20th March 2024. That way. 4 marks, is the marks in here. Those are 4 marks. Those are 4 marks. Those are 4 marks. Not seized trading, seized trading. Ceased trading. Since Moses has really computed this and saying based on the proportion of net profits, this consists of 1% of the net profit, hence not material and not pervasive. Not pervasive for that matter. Not pervasive for that matter. That's a very good analysis. One Moses Otieno. Yeah, so that's why we've done an except for. Otherwise, if it was huge, would have issued an adverse opinion. Would have issued an adverse opinion. Would have issued an adverse opinion. We can lead the other one, although that one I will not write. I will leave you to answer, but I will guide you. Let me guide you. A contract. Contracts were getting by IS number what? You're my learned friends. Yes, IS 11. Contract accounts. We have 2 methods of accounting, PCM and CCM. PCM is percentage of completion method. CCM, you call it? Is it costs? It's the wrong time I lectured this. Here, I can't recall the last time. Was I calling them completed contract method? Or what is CCM? Cost. Cost. Why? Are you sure? Give it a percentage. 100% sure? Yeah, sure. What is CCM? Yes, completed contract method. It's completed contract method. Yeah, nilikuwa nimeanza kujishuku. The last time I lectured a file was in 09. Wrong time. I may have forgotten. It's completed contract method, but I can remember how we used to treat them. Thanks for trying. How we used to treat them. So let me explain something so that you borrow a leaf from this. That if contract is taking like 3 years, so you have the contract price and the cost, so you're able to get the profits. IFRS number 15 discusses revenue recognition. So you cannot recognize all these profits year one. You compute percentage of completion. So year one, this contract we've done maybe 30%. Year two, we have done 70%. This is what we call substantially complete. Then year three, of course, you have done 100%. So year one in the income statement, recognize 30 profits of these profits. Year two, recognize 70% of this minus what you recognized in year one. Year three, recognize 100% of this profit minus total profits you recognized in year one and year two. So that's what you used to do. Yes, the prudence, IS number 18 also discusses this. What if you foresaw errors, that there will be errors in year two to the tune of 15,000 shillings? Actually, you did not apportion. You recognize the whole of that loss in that year that you have foreseen it. Prudence concept, ensuring that we do not overstate profits. You recognize the whole profit, the entire loss rather, for that matter, in that year. So there's an issue there. They're saying we have three contracts, contract 1, 2, and 3. 1 and 2 are substantially complete, and they have made profits, and these profits have been properly accounted for. Contract C is making losses, and they're not reporting these losses because these losses will be covered by the profits made in contract 1 and 2. It's like when you're doing a B sheet and you have some cash at bank, 8 million, then you have an OD of 6 million. You choose to report 2 million aggregate. This is wrong. The financial statements are not complete. Or when you're doing group accounts, you have a COC account, cost of control, where you are balancing with goodwill, which is a positive goodwill on the credit side. Then you have another COC account with negative goodwill, which is a reserve. It's a reserve. Now you aggregate, and when you aggregate, that's very wrong, because treatment of goodwill is totally different with treatment of reserves. It's very wrong. We should not aggregate. This way, the financial statements are not complete. Can you recall the 4 desirable qualities of financial statements? 4 desirable qualities of financial statements: complete, comparable, reliable, relevant. 4 desirable qualities. So when you aggregate, those financial statements are not complete. They are misleading. So this is misinformed, that we will not report losses because we will aggregate the profits made. And we are saying contract price for this contract is 600 million. Only to run into the losses of 50 million. But after aggregating, nobody will know that contract 3 is running into losses. So you as an investor, if you knew that after investing your 600 million in contract C, you will run into the losses to the tune of 50 million, would you still invest? No matter how philanthropic you are, nobody will do that. That you invest 600 million, you run into losses to the tune of 50 million. So that's a major disagreement on accounting treatment, IS number 11. So you issue an adverse opinion. That's adverse. These financial statements are misleading. Somebody will come invest, maybe contract number 1, we are getting 300 million profits. Here we are getting 150 million profits. So minus 50 loss, this is 400 million. Somebody will come investing thinking that this is a profit-making venture. So that person who will invest in contract C will run in trouble because they are losing. So it's a major disagreement. We modify our opinion and issue an adverse opinion. It's a major disagreement. It's a major disagreement. Si hapo tumeelewana? Ni disagreement kwa sababu si tumesema nimefuta hapa. Areas of disagreement. We may disagree on accounting treatment. IAS 11. You're supposed to recognize losses. You foresee a loss. Leave alone IAS number 11. Prudence concept and even the revenue. It indicates when we recognize expenses, when we incur. When we recognize losses, when you foresee them. You see what has happened to this? We have foreseen that Better Limited may not pay us. Outright, it's an expense. Outright, you foresee a loss in its entirety. You record it in the books. You foresee a loss, that's That's an expense. Prudence concept to avoid overstating, profit. So there's a major disagreement of accounting treatment, major disagreement of interpretation of an accounting standard, and the financial statements are misleading. They are misleading because aggregate will have a perception that these contracts are running into profits. They are running into profits, which is not true. Contract C running into losses. So we are misreading as far as contract C is concerned. Sawa. From perspective, from tax perspective also, taxable income loss from each contract should be treated separately and not aggregated. We should not aggregate. The way I've explained, the cash balances with OD, the COC accounts, the contract profits losses, they should not be aggregated. So financial statements in this case, they are totally misleading. They are totally misleading. So leave some space equivalent to this. Maybe you can try like something and write in English. Leave some space. So let's move to the next one. That was modifications affecting the auditor's opinion. We discussed the last one to wind up. Modifications not affecting the auditor's opinion. Modifications not affecting. Yes, all that we've discussed is modifications affecting the auditor's opinion. Number two, modifications not affecting the auditor's opinion. Modifications not affecting the auditor's opinion, i.e., an emphasis of matter, paragraph. Emphasis of matter, paragraph. Emphasis of matter, paragraph. Emphasis of matter, paragraph. So we issue it when we do not have intentions to listen to this one so that we get right. I want to bring out the difference between unmodified and unqualified opinion. Both of them are clean reports, but there's a difference between the two. Check here. This report is modified. So we cannot call it unmodified because it's already modified. Yes. But it's modification not affecting the auditor's opinion. So we still wish to leave the auditor's opinion to be a clean opinion. You remember the errors not affecting the trial balance? The trial balance will still agree despite the presence of the errors. So we still want to issue a clean report despite modification. So this is where we issue an qualified opinion. We issue an qualified opinion because it is a clean report. Because this one cannot be called unmodified because it's already modified. And our intentions are to issue a clean report. So we issue an qualified opinion and introduce an emphasis of matter paragraph, which suitably comes in between paragraph number 6 and 7, right after the opinion paragraph. So it happens like this. Number 6 is opinion paragraph. Opinion paragraph. Then it comes in here where we indicate without, it comes out so well, without qualifying our opinion, you see? So it's without qualifying our opinion. So what type of opinion is this? Unqualified. Because it's without qualifying our opinion, we wish to bring to the attention of intended uses that the client is involved in a litigation for alleged infringement, of certain patent rights. So it's just emphasizing on something without qualifying our opinion. We wish to bring to the attention. Actually, I even wanted to say, would wish to emphasize on, because it's just an emphasis. Then number 7, we do our other legal matters. Other legal matters. So it comes right after opinion paragraph, but before other legal matters comes right after the opinion paragraph, but before other legal matters. Then we can say emphasis of matter paragraph is introduced to emphasize on from number 1, going concern complications. Hii ni ile nilikuelezea aje. If an entity is not a going concern and the books of accounts have been prepared on breakup basis, then the going concern assumption is appropriate. Issue unqualified opinion because going concern assumption is appropriate, but put an emphasis of matter paragraph that without qualifying our opinion would wish to inform the intended users that ABC Limited is facing going concern complications as a result of, you emphasize on something. You want to bring to the attention of the intended users without qualifying your report. Number 2, material uncertainty. And number 3, material inconsistency. Material uncertainty, then material inconsistency. These 3 instances requires that we introduce an emphasis of matter paragraph to explain ongoing concern complications, to explain on material uncertainty, like an ongoing litigation. It's uncertain until it's determined, or material inconsistency. Material inconsistency, I can give you an example of substance of a form. What does substance of a form mean? That you would disregard the substance and record the form. You always say this when you're doing cash flow accounts. Yes, number 7. When you're doing your cash flow statement, you find yourself debiting risks in assets. You have taken a risk asset. So this is an asset account. You debit risk. This is substance of a form. IS number 16. An asset is an item of value owned by the client, but leased item belongs to the lessor. But you find that if it's a permanent lease, you debit in the asset account. That's an example of substance of a form, that we are disregarding the substance and recording the form. So if you meet such an inconsistency, that there is departure from the norm and you concur with it as an auditor, then you introduce an emphasis of matter. You may find an inconsistency, but for some reasons, you concur with it. So you're supposed to introduce an emphasis of matter paragraph. You're supposed to introduce an emphasis of matter paragraph. Yeah, that's the auditor's report. That's the auditor's report. But as we move forward, I know we'll be able to come across more questions. But with that knowledge, I believe we will be able. You'll be able to handle it. Be able to handle it. Sawa sawa. Today we stop at that. Today we stop at that. We can say the grace, let's say the grace together. Now may the grace of our Lord Jesus Christ and the love of God and the fellowship of the Holy Spirit be with us now and forevermore. Amen. So blessed evening. Be safe. Be safe. What's the next topic? Our running friend, our online family. I believe we should be looking at what now? Yes. Group. Yeah, I believe it's an element of revising. An element of revising. Plus those small subtopics, I'll also factor them in. Because for instance, I need to mention something on public sector audit. Yeah, public sector audit. In the syllabus, they've not mentioned about value for money audit. I also need to mention about it. There's no topic on contingents. I need at least to say something about it. DM anauliza tumemaliza syllabus. Hii syllabus imeenda kwao DM. Hii imeenda kwao. But you'll see during our revision how yes, elements of money laundering. These are so what you'll be doing, we revise, then I handle these subtopics because like money laundering has got 3 subtopics. What it is, why money laundering, and how it is executed. We discuss 4 points, and that's it. Yes, PFI is done, Moline, but I will revise it. I will revise it. I will revise it. So let's be sure that next class is on Saturday. Yes, I'm crossing fingers that I'm around. That we will revise on group and PFI. So what wajihami sababu tuko na hizo notes kiambiwa